Well, despite the OECD downgrading global growth, we've got FOMO kicking in. Company earnings and jobs data all pushing markets towards records. My name's Jessica Amir, a market strategist here with Mumu. It's great to have your company on this fourth day of June. Well, the Aussie share market is just a puff away from hitting a record all-time high, and today we'll probably inch pretty close to that mark. Here's a chart of the Aussie share market. It's doing pretty well, isn't it? Look, I think that we can expect unprecedented highs, and that's because we've got momentum now building in the ASX 200, the companies that make up the market. FOMO's kicking in, as we said. We've got company earnings growing stronger than expected here in Australia, and economic growth all supporting it. Side note, what I'm saying does not mean that we won't see pullbacks. It also does not mean we won't see down days. I'm just saying the bulls are back in full force of the market to take it to new highs. In fact, the OECD does suggest that our economy is somewhat in better shape than the US, with both expected to run at slower paces, mind you, thanks to tariffs. Let's just bring you some of those figures. So the Aussie economy, or Aussie GDP, is expected to grow at 1.8% this year and 2.2% next. What about the US? Well, their economic growth has been downgraded. It's expected to grow at 1.6% this year and 1.5% next. Now, the fact that Australia could be outstripping the US does support the fact that foreign investment will probably flow to Aussie shores because global institutions will increasingly look to diversify. Also, just have a look at China. We've put that here down the bottom. It's growing at 4.7% this year and 4.3% next. So that's something for you to consider when you're diversifying your portfolio. But let's just take a step back now and focus on the US for a quick sec. So US stocks, they're very close to records. In fact, the NASDAQ 100 is up 30% from those April 7 lows. Guess what? It's gained more than it lost on the way down. Now, overnight, the bullish narrative was reinforced. We are seeing US stocks continue to move back to record highs. So if we just have a look at some of the moves that we've seen. So the NASDAQ 100 is now up 30%, as we said, from the April low. The fact that it's gained more than it lost from Feb to April, remember in Feb to April, we saw the market fall 24%. The fact that we've gained more than we lost, basically all I'm suggesting is that this suggests the importance of not only one, buying the dip, but also two, always being invested. Meanwhile, what is supporting the market higher overnight and perhaps for the next little while is that bond yields are down, and that's good for stocks. But really critically here, the rally overnight is being led by investors buying into the tech sector, and the tech sector specifically led the 11 sectors higher overnight. Most of the 11 core sectors that make up the sectors of the market were higher overnight. So tech was higher. Secondly, in close second was energy, and that's because the oil price is higher. But really, the world is talking about artificial intelligence. The OECD also mentioned it in its report. But really critically, the fact that we do have NVIDIA once again overtaking Microsoft needs to be touched upon. So the artificial intelligence powerhouse NVIDIA has overtaken Microsoft. It now has a market cap of $3.44 trillion US dollars. Simply extraordinary. And this was basically just the puff it took, that 3% gain in its shares to get it to that level. But as we can see, for those that are tuning in on our podcast, we're basically showing the rally that we've seen in NVIDIA and other big tech stocks up off those April 7 lows. So from the April 7 low, we've seen NVIDIA shares gain 61%. It's now at $141.22. And sure, it's a fair way from its record all-time high of $153.35. I just want to pause on this for a quick sec. Bear with me. The options market is suggesting that NVIDIA could soon get back to $150. No one is suggesting that tomorrow will be back at its record all-time high. But we do have the options market suggesting, sure, NVIDIA shares could continue to run up to $150. Maybe they could even stall or fall then. So keep that on your radar. Maybe it could be time to potentially consider taking some profits. If you are trading or want to lock in some profits, that's up to you. I'm just simply highlighting the fact that options market suggests that NVIDIA could see a bumpy road ahead. As for the other Magnificent Seven tech stocks, we've seen them indeed charge and hold up off their lows. Let's just have a look and focus on Tesla. We can see Tesla, it's done really well. It's up 54% from its April 7 low. It's back at $344.27. Apple's had a choppy run, very bumpy road, but it's holding up, 18% up off its lows. It's now at $203 a share. Microsoft is up 32%. And guess what? Microsoft is the only of these big stocks that is just a puff away from hitting its record all-time high. That's really testament to its widespread global adoption and the fact that Microsoft earnings are continuing to drive its shares higher. But all in all, let's just really keep in mindful that FOMO is really driving the market. It's really pushing this rally into perhaps new legs. I think it's really important to note that we also are getting reports from Bank of America saying that global institutions are underweight in tech stocks. And I think this is also driving the catch-up trade, why investors are now buying back into tech. The reason that they are buying back into tech is because we've got validation that earnings are growing. So we saw earnings season officially almost wrap up. And we've got evidence now that NASDAQ 100 companies are growing their earnings at 24%. 24% year on year. Remember, earnings drives share price growth. We also have S&P 500 companies. They're growing their earnings at 12% year on year. So this is, again, supporting the narrative of investors buying into tech stocks, and this is driving the FOMO trade. Meanwhile, we are also getting delays in tariffs and tariff reductions, but sure, the OECD has slashed global growth. This is why investors are taking bad news in their stride, and they're also looking to gold, also looking to other defensive assets such as healthcare and utilities, which is why these asset classes did well overnight. Plenty to consider as always. Thanks for your company. From all of us here at Moomoo, have a great and happy day of trading.